is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Thanks for coming, Angela. Didn't see you there, but appreciate you joining us today. Angela and I have known each other for some time. She's been on this show several times before, giving thought leader presentations. I went to one of her webinars the other day, and I thought this was really a good one because she talked about the current landscape of the angel investing world and invited her to come back and give us an update. And the title she's going to give us is Strategies for Investing in Turbulent Markets. With that, let's go ahead and have Angela Lee, if you want to launch your slides and kick off when ready.
Yeah, thank you so much, Paul. So just so I have a sense, if folks are willing to type into the chat, maybe like how many angel investments you've done. So you could do like 1 to 5, 5 to 10, more than 10, just so I have a sense of how much experience folks have and little audience participation late in the afternoon. 37 angels, we've invested in about 120 companies to date. I personally have invested in about 30, and then I'm invested in about 5 or 6 funds. So just curious where folks are at. So we've got more than 25. All very precise number. Thank you for sharing. Okay, so while that's coming in, I will go ahead and share my slides. So a little bit about myself. So it's a very experienced group. Okay, so I, a million years ago, worked in product management out of kind of undergrad. I then didn't know what I wanted to do with my life, so I became a management consultant at McKinsey. And then these days, I am a professor at Columbia Business School. I teach venture capital. I teach like 4 different classes on venture capital. I'm also the faculty director of the Entrepreneurship Center there. And then when I'm not at Columbia, I run 37 Angels, which is an angel network I'll tell you a little bit more about. And then I'm also a venture partner at a fund called Fresco, and we do cross-border investing. And then I'm also a recovering entrepreneur and have been on the other side of this very, very fun world several times. And then for 37 Angels, every year we look at a couple thousand startups. We invest in 10 each year, and then we also activate new investors in terms of teaching them how to become investors. We've invested in 120 portfolio companies to date. They've gone on to raise over $2 billion of funding, and we are lucky enough to have a handful of IPOs in our portfolio and 32 acquisitions, and the portfolio is doing above 20%, so we are happy. Okay, so I want to talk about 2 things today. Just what's happening in the market. There's going to be quite a few slides that I'm going to throw at you. I'm assuming you've seen some of them, but I think it's always good to just get a lay of the land, what the heck is happening in the market, and then some things that we're trying to do on our end just to be smarter in this ecosystem. So I think we keep wanting, it's one of those things like if you just keep saying it, it'll eventually be true, which is like things are getting better, right? And we hope they are. I think the story is a little bit different depending on if you're a founder, a VC, an LP, or an angel. And I think the good news is, I think the news is potentially quite good for angels, which I think I'd be probably most worried if I were an emerging VC fund manager right now. I think it's a tough spot to be in that bucket. So deal volume, pretty much back to kind of the peak. And you can argue is this a good thing or a bad thing, and we can have that debate. What is interesting, I don't know why this is happening. So what's interesting is that we're getting more and more large rounds. And I do think I'm sure a lot of us are feeling it who are early stage investors, which is you're just hearing these crazy numbers where it's the founder's very first round, but they're raising 10, 20, $30 million in their very first round of funding. And that is because everyone's talking about the barbell effect in the venture industry. You have on the one end these mega funds. So in 2024, half of all venture capital was raised by 9 VC funds, names that you've all heard. And then 75% of all venture capital was raised by 30 funds. So on the one end, you have these mega funds. And by the way, 2026 hasn't really looked any differently. If you looked at the headlines over the last couple of months, right, you've got biggest fundraises ever by VC funds. So you have that on one end, and then you have on the other end, all of these emerging fund managers raising $5, $10, $25 million funds. And you've got this kind of no man's land in the middle. And the market is increasingly feeling like the have and the have not. So it's mega funds investing in crazy rounds of mostly AI stuff, and then everything else. And the question is, how do you navigate everything else if you can't be one of those top 10 funds? By the way, if folks have questions, feel free to jump in. And the thing that everyone's talking about is where are the exits, right? So things were starting to look more optimistic, and everyone was like, 2025 is the year at the IPO. And I think everyone was really, really excited. The problem is if you look at, I think there were 15 big venture-backed tech IPOs in 2025. Four of them are in the money right now. The majority of them underperformed. And I look at Figma. Like Figma was such a darling in the private markets, and if Figma underperformed the IPO, like how scary is it for any company right now that wants to go public? We'll see what happens with SpaceX, right? And everything going on in the last couple of days around that. But it's a really scary time to go public. And companies are staying private longer and longer because you have mega funds that can fund huge private valued companies. And why would you go public if you don't have to? A, because you have to deal with all the quarterly reporting. And B, you obviously also have to deal with potentially down around a market cap and then your IPO underperforming. So it's a scary time. And I think this is a chart that a lot of people talk about, but I think it's the scariest chart right now that I will show, which is that the light blue is money going into VC and the dark blue is money coming out, and the yellow is net. And so for a few years now, money is not going back to LPs. And this is why it's so hard to be an emerging fund manager right now. Something like 12% of emerging fund managers right now are able to raise a second fund. And the market is consolidating. And consolidating usually means like acquisitions. That's not what's happening. What's happening is that a lot of VC funds are just kind of quietly going away. And we have many fewer VC funds today than we did 5 years ago. Is that a bad thing? I don't know. I think a lot of us felt like there were too many players in the ecosystem a few years ago. But it is certainly, I think, a scary time to be a small fund manager right now. But again, we're not fund, most of us, at least I don't think are fund managers. Most of us are angels. So I wanted to talk a little bit about what this means for angels. Oh, any questions so far on just like state of the market, other things you're seeing before I talk about like some specific tips and tricks that we've been trying to employ?
I had a question. What
Mhm.
what do you see about valuations out there in the AI world? I'm part of a group where I see a lot of AI deals out of the Bay Area, and the lowest valuation I've seen is $650 million. What do you do with that?
So what we do know is being an AI startup automatically increases your valuation by like 1.3x on the conservative X and to like 3x, you know. So it totally bumps up your valuation. The problem is when you say AI startup, I was at the last YC demo day. I only listened to an hour because obviously it's way too many pitches to sit through. But in an hour, I heard what 60 pitches. And I just counted how many of them had AI in the deck, and it was like 75% of them. So at this point, what even is an AI startup? So I think you have to think about what layer within AI you're investing in. I think at the very top, the application layer, I don't know that I think savvy investors are not increasing valuation for that layer. But I think if you're obviously in the more enterprise layers, yeah, you're seeing we all know what OpenAI is worth today, right? So I think you have to ask yourself as an investor is can you truly get into the best deals and are you willing to overpay for them? Because you will overpay for them. And that's actually one thing I want to talk about, which is should we be overpaying for deals?
What about the non-AI valuations? Is there an AI fatigue? Is there interest for the kind of more practical real life stuff?
So I don't know that there is AI fatigue because there is no doubt in any of our minds who are using these tools on a day-to-day basis that the world is fundamentally shifting and that we are still actually probably in the beginning of how things will shift. So I don't think there's AI fatigue. However, I do think that, we know that as an investor, it often is a good idea to be contrarian. And I think that while there isn't AI fatigue, I do think that smart investors should be finding other places to invest in because I think there's value to be had there. And also, the problem with AI right now is that I'm sure you're all seeing this as well. A founder starts a company, they have no background in AI. And so, is that really an AI company? And unless you're an expert, how do you differentiate between the best and the best and what's merely a mediocre company? So what I would say is unless you have deep expertise in AI, I don't know that we should be chasing those deals. That's my high level view. Okay, so let's talk about some practical things. I know everybody on here, again, this is an experienced group, but just to remind us of the risk and power law, right? The normal distribution, we all know this is how IQ, weight, height is distributed, and venture capital angel investing is the power law. And it literally looks like that graph, which is, most of the time we don't get our money back, and we're hoping to be all the way on the right-hand side of the tail hitting those 10x, 20x's, 50x's. And what we also know is when you invest in more companies, your return goes up because you're more likely to hit on a 10x, 25x, 50x company. And so for those of you who are on this call who have, 3 investments or 5 investments or even like sub 10, I would say, keep writing more checks. And, a question I often get from our angels is, should I be doubling down on my early companies and following on? So there are a couple things there. The first thing is there's data to show that when angels follow on, their portfolio does worse. And the reason why is because there's some adverse selection there. Oftentimes, if they have to come back to the angels versus they're raising from their Series A VCs, it's because it's a bridge round. And we know that companies that reach bridge rounds underperform, and I have data to show that. So that's one, is oftentimes if they need to raise from angels again, something has gone a little bit sideways. And the second reason is the power of diversification. So what I always tell people is, invest in your 8th company before you double down on your 4th company, because the power of diversification is just so strong in this ecosystem. Again, this is a sophisticated group, so folks already know this, I'm sure. Well, the next thing is to be wary of bridges. So I want to say 2023 was like the year of the bridge or the year of the extension round, where a founder thinks they're going to raise a Series A, but things go a little bit sideways. So they raise a seed extension, a double A, like you've got all these funny terms for it. And what the data very clearly shows is that when companies raise a bridge round, they do worse. So if you just look at 2019, the black bar is companies that did not raise a bridge. And then the orange is they did raise a bridge. And then on the right is, did they raise a Series A? And it is very clear that when a company has to raise a bridge round, they're much less likely to be able to raise their next round. So, and this is hard because I think as angels, it's particularly emotionally difficult because we're often the first check-in. We know these founders, we care about these founders, and they come back to us, 2 years later, and they're like, look, I promise you I'm 6 months from a Series A. I just need $400,000. And it's really, really hard to not want to give them a little bit more money to keep them alive. And I think this is where you have to ask the question, right? Are you doing angel investing to help founders? In which case, absolutely, right? Like write that check. Or are you really trying to think about what is optimal from a performance perspective? In which case, really evaluate that round critically and don't just say, I want to help this fund, but really say, like, do I really think they're 6 months from a Series A? Am I getting fair terms to compensate me for that risk? What I often find, so like, because you'll think like a seed is raised in year 1, an extension might be raised 2 years later, and they're going to raise a Series A round in 6 months. And the problem is the proximity is they think they're much closer to the Series A than they are to the seed. So what happens is we often pay a valuation that's very close to the Series A for that bridge or that extension. And that is not fairly compensating us for the risk of that bridge or extension. So just show them this chart, right? And just be like, really, like, you have to convince me to invest. So it should not be a default. And make sure that they're raising enough. I think a lot of us have this, it's very common to say, raise enough for 18 months. This is a crazy chart, but if you just look at what's in this black box. So this was a chart that was created at the end of 2025. And what's in that box is people who raised seed rounds in 2022. And you can see that only a fifth have raised a Series A 3 years later. And so we keep saying, raise enough for 18 months, raise enough for 18 months. I think that's too short of a time period, especially given all the weirdness in the market right now. And so A, founders tend to underraise because they're wildly optimistic. B, everything is just taking a little bit longer than we think. So make sure you're really pressure testing monthly burn. I almost always just tell founders to raise, 50% more, if not double of what they have, because I look at their P&L statement. I'm like, you think you're going to pay, engineers how much, right? And so really pressure test burn. That said, one of the nice things about AI is team sizes are getting a little bit smaller. So what's weird is that fundraising has gone up, but team sizes have gone smaller. So, maybe we can be a little bit more conservative on how much we're allocating per team, but still, I would say raise for 24 months, if not 36 months at this point. Questions so far? This is a pretty basic one, term sheet norms, but a lot of, I've been investing since 2008. I'm sure a lot of you have been investing for that amount of time as well. And, there are all these norms. I think sometimes we forget that norms change, and I am very much included. So, for example, I have always been like, I need a cap and a discount. Oh, so pre-money versus post-money. I think people know this, but post-money safes are kind of the default right now. And because of the extension and bridge rounds, it's really important that we ask for a post-money valuation, because that way, even if they raise two extensions after we invest, we are going to pay the post-money that we pay. So we should be always asking for a post-money cap. That said, right, when I started investing, it was always you ask for a discount and a cap. That's no longer the norm. You're seeing a lot of value cap only, or that's actually the predominant norm these days. And increasingly so, we're not always getting that discount and the cap, we're only getting the cap. I will say this, a hard and fast rule for 37 Angels is still we will not invest in an uncapped note or safe, but we are increasingly investing in safes and caps without discounts. And then this was kind of, to me, the biggest thing that we all have to decide as investors is just to develop a perspective on valuation. So there are kind of two ends of the spectrum. One end of the spectrum says, who cares about valuation? If this company exits for $10 billion, who cares? If I invested at 50 million, 100 million, 300 million, who cares? I'll just be really upset that I didn't get that $10 billion exit. And then the other end of the spectrum is, no, we should be disciplined about valuation. So I'm going to kind of give you both arguments. So first of all, what does the data show? So this is PitchBook US data as of the end of last year. Q1 data should be coming out soon if it hasn't already, but I don't have it yet. So you can see that the median, and I'm a professor, so I'm always saying this, look at median, don't look at averages. Averages are very difficult to discern in this ecosystem. But the median pre-seed company is worth 8 million, and then the median seed stage company is worth 16. However, what we're seeing is that the variation in seed valuations is increasing. And so the most expensive seed round is 4 times as expensive as, the kind of median. And so there's a ton of variation. And so how do you actually deal with that variation? So this slide is the argument for why valuations don't matter. So what this slide is saying is that when you look at seed invested companies that become unicorns, there are more of them in the most expensive quartile of seed companies. So what this slide tells us is that we should be investing in the most expensive seed companies because investors are able to detect quality in the seed round. And when we overpay, quote unquote, it's because they're much more likely to be successful at exit. And the data is fairly clear. Now, the problem is it's still only 5.6%, which means that 95% of the time, even the top quartile, they still get it wrong. But it does show that there is a correlation between the best companies and the most expensive companies and which ones end up being unicorns. So the question you have to ask yourself is, can you get into these companies? And you have to be really realistic, right? What are your networks? Are you friends with the folks in those top 15 funds? And are they going to give you allocation in the seed round? If not, then potentially you have to be a little bit more disciplined in valuation. So this is the argument for, yes, we should overpay early stage, because who cares? If we overpay, we're more likely to be successful later. And then this is the argument for, no, you can't overpay, because the majority of acquisitions are happening for companies that are like Series B, Series A, and below. And the vast majority of companies are still getting acquired for under $200 million. So statistically speaking, your most likely exit is a sub $200 million exit. Then you can't pay more than, $10, $15 million, because otherwise, how are you ever going to even hope to get 10x? These days we might be hoping for like 7x. So this is the argument for, yeah, we should be valuation sensitive. I am very much in this camp. Do we occasionally wildly overpay for a deal because we want to get in? Yes, I think actually we're about to do this next week. We're about to wildly overpay for a deal. But if you look at our portfolio of 120, I'm going to say for like 105 of them, I do felt like we had valuation discipline. And we said, no, we are truly going to look at this as realistically, we think they're going to get acquired for what? And then work backwards from there. Any questions on that?
So what about secondaries? Last time you came here, you talked about secondaries were coming out and that the pricing was all over the map. And it just seems like there's more secondaries coming out. But what do you see with secondaries in this case?
Let me see if I have it. I have it in a different deck. So what do we know about secondaries? So the first thing about secondaries is that the secondary market is growing, but it's still only 10% of the market. So this means that most of the time we're not going to have something happen in the secondaries, right? Because it's unlikely that the exit's actually going to happen. And then I did have a slide. Here we go. So most secondaries are discounted, meaning that when you sell at a discount. However, that discount is really collapsing. Something very interesting has happened in the last 3 months, which is that Goldman bought Industry Ventures, I think the biggest secondary fund. Morgan Stanley bought, I forget if they bought EquityZen or Forge Global, and then Charles Schwab. So Charles Schwab and Morgan Stanley bought EquityZen and Forge Global. I forget which is which. So I think that because these institutions were getting in, that this pricing arbitrage is going to go away a lot. And I'm hoping it means that there will be more information transparency and that it will become easier for us to exit in the secondary market. But until I would say literally the last quarter where these big acquisitions happened, the secondary market is just the wild, wild west. I don't know how many, you must all get emails. We get emails like once a month from a random person saying, I'd like to buy your secondary shares. We just had a company where the last share price was $16 per share, and this buyer offered me $5 per share on the secondary market. I'm like, no, I'm not selling to you for a third of the price. So the secondary market's really messy, but I'm hoping becoming increasing less so.
Do you see more companies baking in the exit in the early stages? When we get to this place, we'll do a secondary or we'll do a tender offer. We'll do something to pay you back. You see more of that coming up?
No, and I think that founders who say that and promise that in some capacity are really just blowing smoke. There's no way for them to guarantee that at the early stages if they're going to be able to have a secondary market, a secondary exit, or a tender offer.
Okay.
It's kind of the like every deck we see is we're going to be profitable in 2 years, right? I think that's the other really common one.
What about the guys that are offering to get you into the pre-IPO of SpaceX and these other things? And are they really shareholders or do they have authorization to sell the shares? What do you do about those guys?
So there are two caveats. The first thing is you really, really have to know what you're buying. So I've talked to folks who are really knowledgeable in the secondary space, and what they're seeing is there are these shares where you think you're buying a share of, OpenAI or SpaceX, but it's not an actual share. It is something that looks like a share of that, but there are limits, like you can't make more than 10x, or there are all these like restrictions on it. And so you're not actually getting a share. The other thing is when you buy secondaries, you typically are buying common stock, you're not getting preferred, so you don't have information rights, you don't have protected provisions, you don't have liquidation preferences. And so I think people don't know what they're buying on the secondary market, and there are a lot of bad actors in the space. And then secondarily, in my experience, when it's a really hot product like, OpenAI or SpaceX, it's selling at a premium. So let me see if I think I might actually, oh, here we go. It was literally the next slide in my deck. Oops. I'm not sharing anymore. Which is that when it's a really hot deal, it's sold at a premium. But the problem is when it's sold at a premium, and then you look at the post-IPO performance that I just shared, you could be in a lot of trouble if you pay a premium to the last private valuation and then the post-IPO market tanks. You're now like 80% down. It's bad. So I'm not saying don't participate in secondaries, obviously, but just really, really do your research. I think the last thing I had was just to keep learning. So these are the reports that I read kind of every quarter. I'm assuming you all are reading them as well. But if you sign up for CB Insights or PitchBook, they're free and they come out every quarter, so I kind of know what's going on in the market. For those of you who want to know what our diligence criteria are, you can go to 37angelsforcom/download. If anybody wants to take our investor bootcamp to learn how to be an angel investor, you can go to 37angels.com/training. And then we also have a bunch of resources on our website, a vet newsletter, all the New York accelerators listed by sector, and then resources for female founders, diverse founders. And then we have a glossary. And that's all I got.
Great. So if they want to copy the slides, is that the download link?
No, although I'm happy to share slides with you, Hall. But no, download is our diligence memo framework, like what we look for in diligence. And then this is our bootcamp. You're welcome, honey.
Got it. Okay, great. Well, if they want the download, guys, just email me. I'll put my email in the chat box, and I'll work that out for you guys, and put you in touch with the Angela here. And appreciate you doing that for us, Angela, today, and looking forward to seeing how this market shapes out. It's going to be an interesting year for sure with all these IPOs and M&As and so forth. But with that, are there any other questions for Angela? I think we'll go and wrap it up. Thanks so much for coming, Angela, and we'll see you next time. Appreciate all the good things, and thank the presenters as well for your presentations, and investors for your questions. Thank you so much, guys, and we'll wrap it there. Have a good one. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.